All right, guys, veteran here with Independent Traders Guild, ITG for short, and I'm going to do a shortened series, video series on some ITG stuff that we do in-house, and obviously probably the most popular thing is PVI. So here is our 2024 year in review, and I'm just going to walk through the spreadsheet. Lots of questions. We've called it income generator as a model income that I used to do when I ran a hedge fund, all option based. But to give you an idea, again, just through the columns, we'll walk through it. Each week we've had 49 weeks. Year to date, this is the 50th week, so we got 2 weeks left after this. Just the date range, markets open. And then the actual PVI. I'll spend more time talking about that in future videos, but just this is the range low to range high. You can see the first 5 weeks. We're using decimals, 40, 46, 35, and 27 cents. Again, I just stopped doing it. It doesn't make sense to spend the extra hour going through work in decimals, just round up, round down. It makes it a lot faster. The yellow means that we breached it intra-week. So we breached, if you look here at the close, 52.34. We breached 52.54 at some point and came back into the close. Here, 49.67 was a close. So we probably breached the low. We did. That was when Israel launched back on Iran, and then they called it off, but we breached overnight in ETH. And then the final breach, which was an actual closing breach to the upside, or I'm sorry, to the downside, 54.08, 54.62. So we've had 3 breaches intra-week and 1 closing breach. So we're technically, as of last Friday, we were 48-1. So this is SPX open on Monday morning. Here's the close. And then if you look at PVI, I don't like doing the decimals, but let's go here. The short put and the long put, typically these are 100 wide, okay? And the reason why is when you want to sell theta, you want to sell wide, you want to buy tight, so that you don't have theta eat into your profits over the course of the week. So let's go to last week. PVI low was 58.52. We sold 58.50s. We longed the 57.50s, and we clipped $1.25. Now, some of the stuff that'll come up in here, the previous week, 57.46 was low side, and you'll see 5900, 59.75. Well, this is 0DT, and it's really hard to stipulate all the different asterisks for what it could be, but this was 0DT. So this is, we're selling inside PVI. Sometimes we'll sell premium on a Thursday, 1 DTE. Some days we'll sell it on a Friday. I know we sold the Friday call side. Again, the high side for calls was 61.29 2 weeks back, and we sold the 60.45s. Now, because of this, and we went tighter, the amount of risk is substantially less. So if you're selling 500 wide on the call side and 500 wide on the put side, you got 50K at risk. This is the amount of premiums that we receive for the put credit. Here's our short call, here's our long call, and here's our call credit. So in the event like here, this was a diagonal, right? I bought Monday 5400s. We sold Friday 53.75s. We only got 10-cent credit for these. Not much credit, but we got paid a little bit. And again, if you're doing a diagonal, which means you have different expiration date and different expiration strike, that's a diagonal. And I do my best to fill this in. We don't adjust from this a lot. Here we went and we did ESs. And the reason why is we were selling inside PVI. And so it was kind of a 1 DTE. Here is a Monday, Friday strangle or diagonal as well. And again, so all you're seeing is here's the call credit. Number of contracts, typically we're at 5. Breach week, I went up to 7. We sold a lot of extra premium on breach week. We used the premium to buy put debit spreads. This is showing as a loss. Technically, this was not even a loss for the PVI portfolio, but talking to the people in ITG, we looked at about 75% of the profits from futures could count, but the rest of it wasn't going to count, and so that's where we derived this from. Again, the issue is about being equitable. It's not about me trading this system. I don't expect most people are getting these premiums. Now, people in ITG, there is a PVI Trades private channel. It's locked. I'm the only one that can post in it. I post in it, and the only thing in is entries, exits, adjustments to the portfolio. Again, this is a managed portfolio. I don't own this portfolio. I manage this portfolio, and so I can't deal with withdrawals and add money. I can't do no. I don't have any. I don't have any responsibility with the portfolio other than I trade it, and this is the premium, and this is how their account sets up. So with it, you get total number of contracts, total premium received, and then how much is our capital usage. Again, here we got a 75 wide. Here we only got a 85 wide. So that's the capital usage. Again, it's going to go to the widest spread. A 50 wide call spread and a 50 wide put spread. Adding the extra call spread does not change your capital, your buying power usage at all. ROC is return on capital. How much did we use? How much did we return? PVI, did we close inside our PVI ranges? Yay or nay? It's yay, all but this one. Not sure why that is messed up, but I'll change that after we're done. And then this is probably the most important column. The weekly P&L is not the total premium we received. It's the total premium that we kept. So here, we kept it all. We let them expire at 0. Here, $22.90, $21.83. So we gave back about $87 in premium. What did we do? Probably close some trades on Thursday or Friday for 5 cents. Again, 2,800, 2,800, 1820, 1820, 3275, 2973. So this can be how much did we close them early, or did we lose some money here? Do we have less money in our weekly than our total premium in our actual profit loss column because we spent money to hedge, and that happens a lot. Here, 37.70. We actually went above 50 wide, which meant we sold more than 100 wide. Oh, that's why, because it was ES, not NQ. Not SPX. So we did SPX on the long put, and we ended up selling ES, and it was probably maybe a Sunday night deal. Maybe Globex futures on Interactive Brokers were not open yet. Again, there was huge premium here. So we went a little higher than 50,000 this week. And then I know we did again on breach week. But we also went lower, right? 35, 35, 42, 45, a 40K and a 35K. And so down at the bottom, your average weekly buying power is still under 50,000. So anytime there's less premium, like here, this is how much premium we received, 27.40. But this is how much the losses were. So again, if you spend money on hedge, then it shows here. And through week 35, all the way to week 35, the unhedged portfolio was totally kicking ass relative to the PVI portfolio, the hedge portfolio. And the reason why is 1850, 1487. A lot of these, like here, only $1,000 that week, and I closed some early. 1040 that week, and we closed some, early. And so we gave back about 20% of the profits here. And again, I can't go back and say exactly why I closed them out. Sometimes we hit, 15 cents on a Tuesday, and there was data later in the week, and we just closed them out, or 20 cents. Typically, if we hit premium and we can hit 80% by Tuesday, I'll close the trade out, and then we'll do a 0DTE trade. But I want to walk through the spreadsheet and the way it works. So this weekly P&L is all that matters. The total premium, it kind of gets hodgepodge because sometimes you'll start scalping one contract. Do you add that to the total premium? If you don't add it to the total premium of how much you receive from it in the call credit or the put credit, it's going to get skewy over here. But again, math is math. We try to be as transparent with the math as possible. Here's your year-to-date profit, 18. Now, the year-to-date return, this is not a return on your capital at use. This is a return on a hypothetical, let's start every January with $100,000. In this portfolio, I think we started with 109 or 114 on January. It's their portfolio, withdrawals and everything. And they're at like 270 now. But all the profit trades this year has been really from PVI and then me trading futures in their port. So the weekly return is this return. The aggregate year to date is basically you're adding week 1 plus weekly 2 into here. Now this year I've started trying to work down and work a monthly return to aggregate the previous month. And again, some months are 4 weeks, some months are 5 weeks, just depending on where it lays. And again, it's kind of a misnomer. Again, data can be skewed, but we've tried to look at what the monthly return is. And the reason why is we had a lot of people asking about our Sharp performance. But the issue with the Sharp is if your monthly changes, like August was the best month of the year, September with the breach on Labor Day week was the worst month of the year, that standard deviation right here has a negative impact on the Sharp ratio. Huge. Like the Sharp ratio up into August was almost 4%. And again, the average annual risk, take it by the week, divide it by 52 weeks, and multiply it by how many weeks we're at to kind of give you, I think after this week, we're at like 3.72. Will be the average risk-free. But it doesn't make a whole lot of sense to overanalyze the weekly performance and the monthly performance, but it does kind of give you a gauge as to where we are. So the returns here, year-to-date, and this big yellow column's the important one, the $89,754, that is off of basically $50,000 at risk. So if you had a 50K portfolio and you said, look, I'm gonna go all in with 50K, and I'm gonna win or lose. If you don't breach until later in the year, technically you're up over 100% off your amount of money at risk. If you're basing it off a 100K portfolio, you're at 89,000. The reason why I use the 100K, because we're putting 50K at risk. You'd never really want to risk more than half your portfolio doing this. I do it, but I built this system, 20 plus years ago. 2005, I was running a hedge fund with, this process. So again, I have a lot more experience at this than the majority. So I have, I'll have a $50,000 IRA for, an Army buddy or something, a 401k or whatever, and I'll sell $50,000. I'll do 100%, at risk on their portfolio. But I've done this for a long time, but I just want to kind of explain that to everyone as we go. So here's our average weekly income, and all they're doing is this is just Excel spreadsheet averaging this table. Average weekly buying power deals with this column, and then the average weekly return on capital is our average weekly income divided by our average buying power, how much we're putting in there. And so we're averaging about 4% a week for the amount of money that's at risk, which, You're not getting that in 99.9% of any discords or from Wall Street. Here's our total profit and loss, including hedges. What I don't count is if I hedge and I make money on the hedge, that does not get counted into here. So if we buy call debit spreads, put debit spreads at weekly supply demand levels, and they profit because we finish above them, outside them, we don't count that in this. This is strictly, we're selling options on these PVI ranges, and if it finishes inside the range, how much did we sell for? How much do we keep? And what we keep is what matters the most. The unhedged portfolio is you're putting the money in, and it's a ride or die. So this week, we closed at 54.08. You put money in at 54.60. So 52K. Again, I wouldn't have, you don't go 7, you only go 5. But 52 points times 5 contracts. You'll see that's that month number. And so that sum is all of the total premium you receive for the year, less that drawdown. That's what the drawdown cost you, 25K. So imagine if you started the year with a 50K allotted to the unhedged portfolio and we breached the first week. Well, you might have lost half your money. If you don't breach until here, you'd already made $71,000. So even losing $25,000 isn't going to kill you. So not doing anything, you're still over 100% rate of return from the amount of money at risk unhedged. And why? It's because the ranges are, again, there's so many data points in these ranges, and we've refined them year by year by year by year by year and built the system to last. So here's the monthly premium, monthly performance for the year, January, February, March, April. So when I post it there, typically we attempt to get 8% a month. You can see when the VIX is low, it makes it really hard. Okay? And then the final thing that I'll cover here is our yearly performance. So in 2020, COVID hit, we were all cash, and I went straight to SPX. Let's trade weekly instead of monthly. Up until 2018, I was trading only monthly portfolio on SPX and really SPY because that's how the hedge fund was working. I just kept doing it for private clients. But in 21, all of this is 100% weekly SPX options. 92% return in 21, had 115%. And again, that's not on the capital. That's 50K at risk. But basically, this is 115,000 we made this year, 92,000 we made this year, 94K we made last year, and right now we're sitting at 89,000, for this year. So, are we going to get 100%? I don't know. I always call it the journey to 100% because that's the target. If we can get 8% a month, we're going to be pretty damn close to 100%. If you fall short and you make 72, big freaking deal. You're still going to triple the returns of the S&P 500. You're going to do so in a managed portfolio if you're with us. If not, and you're just dealing with the ranges, you need luck. You need PVI not to breach the first 3 weeks of the year to build up a little bit of cushion. And so again, with it, standard deviation over the last 4 years, we're at 0.103. Standard deviation per month, right now, we're working 0.022. This will all come out in the wash when we work over to a yearly because of the average annual risk and the number of dates. And this will be one return, not standard deviation by the month. This will be our standard deviation for all 52 weeks, and it'll be a lot lower. It'll be a lot lower than that, and so our Sharpe ratio will be substantially higher. Now, if you reached out and said to a hedge fund guy, hey, I'm following this guy on Discord, and he runs this SPX Theta portfolio. It's similar to Iron Condors, but it's not. But his Sharpe ratio is at 9%. They'll tell you you're smoking crack, and then you start asking about referrals. You start asking about other hedge funds that have dealt with us before. hedge funds that I've been a third-party private manager for, and next thing you know, you're like, yep, it's over a 9% Sharpe ratio. Here was 23. You can see we usually have 3 breaches a year. The red column, the yellow column, we had 7, 2, 4, 6. Yep, we had 7 breaches intra-week, 3 closing breaches in 23, and we cleared 94K. 22, 1, 2, 3 breaches. This one hurt, right? If you're in an unhedged portfolio, we breached the 3rd week of the year, you're hurting. Now, how much did we breach by? 43.97 from 44.97, 100K, 100 points. So there's a lot of luck when you deal with the unhedged portfolio. But again, 3 breaches, and then we had how many? 2, 4, 6, 7. We had 7 intra-week breaches, and 3, 7, and 3. And this year we've got 3 and 1. 3 intra-week breaches and only 1 closing breach. Is the data getting better? Maybe. Is the market starting to settle down a little bit? Maybe. Bull markets are easier than bear markets. False. Bear markets are better for us because you get this. You get this $16 put premium. Look at the call side. Highest call side we got, 340. Look at the put side. 16, 394, 319, 622, 330. Guess when you get paid to sell? When there's blood in the streets. 471, 328, 345, 316. Again, the put side is what pays you and does the system. Now, the system that I've designed, that I trade off of, is designed to breach more at the upper side, the high side, than the low side. And the reason why is if we breach the call side, your 401k's up, your savings rate is up, your house is worth more, because we're breaching when the market's making like all-time highs. The problem is the call skew on the premiums is so far reduced that the actual portfolio, look at the best year we got so far on the weeklies. The year we had a bear market all the way until October. So down years, this pays handsomely. Up years, your 401, like this year, like last year, your 401k, your IRA, your thrift savings plan, 403b, your 457s, 529s, anything that has mutual funds in it, that has equities in it, they're going to do better when the market's in a bull run. This is a counter system from a standpoint of it really doesn't matter. We're gonna shoot towards 100% every year. Years that the market is dropping, we have an expanded volatility, a higher volatility. That means we've got more premium in the mix, and the more premium in the mix, most people think that when the market's risky, you sell less, and that is counter to statistical analysis. When the market is in chaos, you sell more, and when the market is calm, you do not size up. You do not size up to get more call premium when we keep making all-time highs. That'll kill you. You just be content that says, hey, we're going to make 1% a week, 1.3 a week, 1.25 a week, 1.3 a week. Why? Because it's going to come a time where we're going to get a 3% a week. You want to eliminate the negatives. No negatives is kind of how this program has had so much success over the last couple decades. Now, why do I not size up? Because the portfolio will not allow you to go. You can't lose any more money than you got at risk. And so if you limit yourself to 50K at risk, you're going to lose 50K. If you've ever been in a spot where you've been worth 7 or 8 figures and you've gone to a spot where you've lost it all, you don't want to go back there. And that's the whole process. I have an earmarked amount in my portfolio that designed just for this system, and it limits how much money I can lose regardless of my ability to hedge. I have a maximum amount of money that I'm willing to lose in this process For mine, it's 250K. And again, so if you multiply that by 5, then you can kind of get an idea if the average is generating, 1.8 or 1.8K a day or a week, and you multiply that by 5. That's kind of what makes us tick and go. All right, guys. Hey, I got plenty more videos. They'll be shorter. This is kind of the big one that everybody needs to understand how to read the spreadsheet, what all the columns mean, and how it all works. All right, guys. I am out. Peace.